RBI Monetary Policy Preview on NDTV Profit. I'm your host Pallavi Nahata. And the Monetary Policy Committee is set to meet on Friday to announce its decision on Friday. It is most likely to continue to maintain a status quo on the key lending rate, the repo rate. This is amidst the continuing need to bring down inflation durably, even as economic activity continues to remain fairly strong. All economists polled by Bloomberg expect a status quo. Now, since the last policy that was held in April to this one, the Monetary Policy Committee will re-evaluate easing inflation, resilient growth, the onset of the southwest monsoons, international oil prices and global geopolitics. Now, it's also, of course, the first monetary policy since the elections have taken place. Let's take a quick look at where we are on inflation as well as on growth. Retail inflation last came in at 4.83% for April, but food and beverage inflation continued to remain very high at 7.9% for the month of April. It's shown no signs of respite from the previous month. Headline inflation is projected to ease over the coming months. The RBI projects inflation in Q1 at 4.5% and in Q2 at 3.8%. We're also going to closely be tracking the southwest monsoons and their distribution. Meanwhile, GDP growth, of course, remains strong and continues to surprise on the upside. It came in at 7.8% for the January-March quarter, and for FY25, the RBI projects growth at 7%. So that's yet another year of 7 or 7+% of growth. But most importantly, tomorrow we're going to be watching out for what the RBI says and does on liquidity management. What measures the RBI might possibly want to introduce to regulate changes in liquidity from passive inflows, from index inclusions that start in June. Now, I'm joined by Dheeraj Nim, economist and FX strategist at ANZ Research, and Rajani Sinha, chief economist at CareEdge. Thank you very much to both of you for taking time out for us. So, Rajani, I'll start with you. What are your quick expectations from tomorrow's policy?
So, Pallavi, like you said, we are expecting a status quo on policy interest rate as well as on the stance. There are too many uncertainties, and I think at this point RBI would just choose to wait and watch. Probably as they get a little more visibility on the progress of monsoon, the stance taken by the new government in the budget, and also they would like to get some idea of US Fed's decision. So I think RBI is going to wait and be cautious on specifically on how food inflation moves before they make their decisions in the later policy meeting.
Okay, all right. Dheeraj, coming to you, I know we expect a status quo both on the benchmark rate as well as on the stance, but absolutely any chances of a change in stance?
I don't think at all. I think the most important variable before the RBI, that is inflation, is still in a bit of a red zone. In fact, if I were going by my calculations for the month of May, I think there is a slight chance that inflation may have accelerated from 4.8% the previous month. And I think some of the vegetable prices which are experiencing the summer increase, the seasonal summer increase, are possibly pushing food inflation a bit higher. So I think the RBI will continue to remain slightly uncomfortable about how high food inflation is, and I don't think there's absolutely any chance for the MPC as a whole to be dialing down their hawkishness by the way of communicating any sign of dovishness in their stance.
Okay, all right. And Rajani, coming to you, what are your expectations from the inflation print going forward? We did talk about how the RBI's projections indicate some softening in inflation, especially in Q2, before we once again see a little bit of an uptick. But what are current trends indicating?
So our expectations are very similar to RBI's projection. So we are expecting that inflation will moderate a wee bit more from the current levels in the second quarter of the fiscal year, but it will inch up again in the third and fourth quarter of the fiscal year. Overall, for the fiscal year, our average inflation projection is a little higher than RBI's projection. We are expecting around 4.8% average as against RBI's projection of 4.5%. And the main concern remains on food inflation. So like Dheeraj highlighted, for the latest, the number that we are expecting for CPI, we are also expecting some acceleration from the 4.8% level that we saw in the last month. And the main concern remains vegetable prices and pulses prices. Moreover, even cereal price inflation at 8% or so is high. So I guess food inflation would remain the cause of concern for the central bank.
Okay, all right. And Rajani, that's despite the southwest monsoon outlook at this point, we do expect above average monsoons, above normal monsoons. And so far we have seen timely onset of the monsoons as well. That does sort of bode well for the season going forward. How does that change things? How are you looking at that?
So we are expecting food inflation to moderate going forward if we get monsoon, not just a normal monsoon, but also the spatial distribution and the temporal distribution of monsoon is good. In that case, we are expecting food inflation to moderate, and we feel that RBI would mainly be cautious on food inflation. So if food inflation starts moderating, which is what we have factored in our projection, we are expecting that the central bank could cut policy interest rate by the end of the calendar year. I would say it was the second half of the fiscal year. So that assumption is mainly based on expectation of food inflation moderating in the coming months.
All right, and Dheeraj, coming back to you, what is your, how are you looking at the inflation trajectory going forward? Also, so far, Rabi sowing trends have been more or less at par with expectations, right? The Rabi harvest, I mean.
Right. I mean, there's not a lot of surprise there, but like Rajani mentioned, we are waiting for a lot of variables to throw up some clarity. The news so far on monsoon has been quite encouraging, and we need to still see how it pans out throughout the season. My inflation projections are, somewhat similar to the RBI's, but I'm expecting for the whole year slightly lower inflation at 4.3%. So that's the other end of the range that you have today compared to Rajani's higher than RBI forecast. A lot of it is also coming from the fact that, core inflation has been quite weak, but like Rajani said, we would be also waiting for food inflation to subside before we can think about, the Reserve Bank of India beginning to change the policy rate.
Okay, all right. Coming back to you, Rajani, I do want to talk about liquidity management. We have seen the RBI take a fair number of measures to actively manage liquidity in recent months, and now especially given that we're already in June and we're soon looking at flows from the index inclusion. What is the RBI going to do? What is the expectation from the policy tomorrow as well as going forward?
So in tomorrow's policy, maybe on the liquidity front, we may not get any announcement. But going forward, I think RBI would be comfortable with a little surplus liquidity because we are factoring in an interest rate cut by the end of the calendar year. So RBI would be looking at changing its stance probably in the October meeting and cutting rate in December, provided food inflation moderates and there are no more climate risks coming up. So in such a situation, we feel that RBI would be comfortable with a little surplus liquidity, but at the same time, they wouldn't want abundant liquidity in the system because they wouldn't want inflationary pressure to again go up. So in that sense, we expect RBI to continue with liquidity management tools, which they have been doing, to ensure that there's just about enough liquidity in the system. Now, that brings me to the question which, the market is pondering over whether, there's going to be any additional liquidity controlling tool in the form of, say, OMO or MSS. It's difficult to say at this point because, the liquidity that we are expecting is mainly from FPI inflows, and that's something which can be, temporary in nature. So in that sense, while we feel that RBI would come up with some liquidity measure to take away the abundant liquidity that we're expecting in the system. But I'm not so sure whether they will do an OMO. They can look at MSS also, or maybe some other liquidity measure RBI will come up with.
All right, Dheeraj, I do want to ask you about that as well. Given that we're already in June, what are the expectations in terms of liquidity management going forward? The RBI is likely to absorb much of the flows that come in from the index inclusion. What do you think are the kind of tools that the RBI would then rely on for that?
So probably in the immediate term, I don't think there would be any deviation from their time-tested policy of using temporary tools to manage banking liquidity. Now, if you look at the liquidity evolution and, the weighted average call rate evolution over the past few months, it's kind of hugged around the policy rate. So I don't think there have been any particularly wild swings in liquidity and the call rate to worry the RBI on either side. But here, as we stand, there is a couple of variables which are looking somewhat uncertain. So for example, the index inclusion inflows that we are talking about. So let's be aware that these are going to be passive inflows. They're going to, they are portfolio inflows by design, by nature, but then they're going to be passive inflows, which means that they would tend to stick around unless something drastic really happens. So as I said, of course, the RBI would be absorbing most of this money that is coming into the Indian markets, which would mean an upside to liquidity. I think the RBI would be somewhat comfortable having a very moderate surplus liquidity at the moment, also because the government cash balances with the RBI are quite elevated at the moment. And until there is more clarity on the government spending, we are awaiting the full budget in July. I think the Reserve Bank of India would want to tread cautiously before, announcing any measures of liquidity absorption infusion, which could be less temporary in nature. So I think it would be a bit of a wait and watch. At least for tomorrow, I don't expect any major announcements. But their insistence that, they would be willing to utilize whatever tools they have in their kitty to manage liquidity on an ongoing basis.
Okay, with the RBI monetary policy preview on NDTV Profit, and I'm joined by Dheeraj Nim and Rajani Sinha. Rajani, coming to you. So, while we've spoken about inflation, I'd like to come to growth. GDP growth, of course, surprised on the upside. Currently, in the ongoing quarter, are there any signs of a slight loss in momentum? Maybe manufacturing and services PMI came in very recently, and both, though they continue to remain very strong and they continue to remain well above 50, we did see both of them coming in slightly lower than in the previous months. So any signs of any loss in momentum or nothing of that sort?
Pallavi, I would say 1 month data would be too early to conclude that there's a loss of momentum. We would like to wait and watch as to what happens going forward. But broadly, from the various high-frequency indicators that we have been getting, be it GST collection, auto sales, credit demand, you talk about, most of the indicators, I would say, are quite strong. We would want to wait and watch to see whether the momentum is sustained, rather than draw any conclusion from one data point. The critical thing to watch for is whether, what everyone would be very keen to see is whether the consumption sees revival going forward. And that's where rural consumption becomes important. So whether FMCG sales volume are picking up, which as per the last data that we have from Nielsen, it is showing an improvement from the rural area. So those are the critical aspects that we would watch over a period of time to draw a conclusion. But broadly for FY25, our GDP growth assumption is in line with RBI's projection of 7%.
Dheeraj, coming to you again about GDP growth for the ongoing fiscal as well. Like Rajani said, it's too early at this point to maybe assess what the economic growth situation looks like, but it does look like most indicators continue to hint at strong and fairly resilient growth currently. I do want to understand then on what basis are we expecting a slightly lower print for the full year? Is it simply the base effect, or this year are we also expecting a little bit of a hit on urban consumption because of monetary policy? So what's happening there?
the base effects is an obvious reason. It's a statistical reason that the full year growth number has to be lower than the blistering 8.2%. I slightly differ on that. I think, if you smoothen out a host of high frequency indicators, they do tell you some indication of peaking as far as domestic demand is concerned. Now, there is, of course, one silver lining in that, and I was looking at a host of construction indicators and real estate indicators. They don't seem to be showing any signs of exhaustion. And mind you that a lot of India's growth story right now is resting on the shoulders of investment spending, and a lot of it is coming from the construction sector. So it's quite heartening to see that one growth engine is not slowing down particularly. But I do believe that, consumption, which is the largest component of GDP, may have a limited upside in terms of growth. I agree that there have been signs of rural revival, but of course it's coming from a really weak base. So we need to see much further consolidation for rural demands to become actually a driver of aggregate private finance consumption. Urban demand has moderated more or less, but at the same time I would like to draw your attention to what's happening, to the household portfolio. Now, if you marry savings data, for example, that one we had from FY23, it's clear that households are focused on building assets like houses. So that's why you see an increase in physical savings of the households, and their net financial savings have taken a bit of hit because they've taken on a lot of leverage. There's a lot of debt on household balance sheets right now. So even from a structural perspective, I think for several quarters, it could very well remain the story that private consumption does not rise to become a growth driver per se. So I believe that growth is indeed switching to a lower gear, but certainly not anywhere to worrying levels. So I do believe that growth in FY25 would be about 6.8%, which is close to potential. And not below that. In all of this, I do think there's one more point of encouragement, which is what's happening on front of exports. So we've got the PMI data. You see export orders; they continue to remain quite resilient, and global demand is, of course, surprised slightly on the upside in the last few months. So I hope that story continues, and we continue to see decent growth momentum.
Okay, all right. And Rajani, I do want to get a quick view from you on the 10-year benchmark GSEC yield as well. We did see a little bit of a knee-jerk reaction, of course, earlier this week, but the midterm view currently remains that we do expect yields to continue to soften a little bit. Is that right?
So, Pallavi, given that we are factoring in rate cuts towards the second half of the fiscal year, we are expecting 10-year yields to go down. We are expecting around 6.6% or so by the end of the fiscal year.
Okay, all right. And Dheeraj, one last question before we actually wrap up. What's your view on the rupee? And would you see the rupee remaining range bound over the next few months, or can we expect any change there on the rupee's view?
Look, the rupee remaining range bound is entirely dependent on how the Reserve Bank of India wants to manage the exchange rate. And I don't think there has been any shift in their FX policy because of whatever number of events we have seen in the recent weeks. Now, there's a few moving parts there. The first is, of course, what happens to the dollar strength. For whatever reason, we still don't have much clarity on the Fed rate cuts. And the incremental data continue to show that they're nowhere close by at the moment. So we remain watchful of what's happening to the dollar, but if the disinflation process in the US is still intact, we think that the dollar may have likely peaked already, and there are very minimal risks of it resurging back. That's one. The second angle, and I personally think quite an important angle, is to what's happening with the yuan. We should be very mindful that rupee's competitiveness against the yuan is quite crucial in India's growth story as well as foreign exchange policy. Also at a time when yuan's real effective exchange rate has become quite undervalued, right? So which has made Chinese exports quite competitive. So that's the other angle. And the third angle is, of course, rupee's own events, so to speak. For example, the election-related uncertainty that we witnessed. We saw RBI very actively trying to contain the volatility, and that is one piece of this entire story that I think will continue, because the RBI's FX reserves are formidably high, so I think they would not be shy to spend them if they see any volatile risk events taking place, which is temporary in nature. Overall, I think fundamentally, from a balance of payments perspective, the rupee should appreciate over the year, but yet again, on the downside for USD INR, the RBI will be standing pat to absorb most of those inflows to build up the reserves further than letting rupee appreciate meaningfully.
All right, and with that, we're completely out of time. Thank you so much, Dheeraj and Rajani, for taking time out for us today. Do stay tuned to NDTV Profit for our continuing coverage on monetary policy tomorrow.